Most people do everything right. They save, they invest early, they grind 60-hour weeks for decades, and they still wake up at 50 wondering why nothing has changed. Here's what nobody tells them: they were playing by the wrong rules. I went from cleaning buildings to running multi-billion-dollar operations, and the one thing that changed everything wasn't my hustle, my degree, or who I knew. It was understanding that money doesn't follow rules, it follows laws. Break a rule, you get a warning. Break a law, you pay. Slowly, quietly, for years. Most people never even know what hit them. Here are the 7 laws that govern how money really moves, and a 3-part system that separates wealth builders from paycheck collectors. Momentum compounds your speed. Structure decides who controls the money. Asymmetry lets you capture massive upside while limiting your downside. Master these 3. Everything else is noise. Law number 1. Money likes speed. Wealth likes time. Early in my career, I flipped houses. Off-market deals, fast renovations, quick exits. Over 5 years, I flipped 100 homes. Great cash. I thought I was winning. A friend took a different path. One single-family home, then a fourplex. Then he refinanced and bought a 20-unit building. No flipping, just patience. 5 years later, his net worth was 5 times mine. I chased speed. He weaponized time. Speed is shrinking the gap between seeing an opportunity and acting. Time is making a great decision and leaving it alone. A good decision looks average in year 1. In year 10, it looks like genius. Berkshire Hathaway compounded at nearly 20% annually from 1965 to 2024, doubled the S&P 500. Total return, 5 million%. That's not intelligence, that's time left alone to do its work. Law number 2, whoever controls the money controls the terms. I've sold 5 companies. Every time, the buyer made 10 to 100 times more than I did, not because they were smarter, because they held the capital. Look at the Forbes 400. Almost nobody got there on a salary. The vast majority are builders and buyers. Musk, Bezos, Zuckerberg, Buffett, people who own things. Facebook bought Instagram for $1 billion, now worth $45 billion. Google bought YouTube for $1.65 billion. It became the internet's second homepage. The owner of the Anaheim Ducks turned $70 million into $1.6 billion. Buyers set the terms. Buyers create markets. Without buyers, there is no market. You don't need millions to apply this. You need the obsession. Start small. Buy and build. Momentum follows. Law number 3. Leverage multiplies everything, including your mistakes. I almost lost everything once because of this law. Not because I misunderstood leverage, because I underestimated it. I borrowed heavily on a commercial deal. The asset was solid. The market was strong. On paper, it was perfect. Then, interest rates moved. Cash flow tightened. Suddenly, the same leverage that was supposed to make me rich was threatening to wipe me out. I survived, barely, and I never forgot the lesson. Leverage is the most powerful financial tool in existence, and the most dangerous one in the wrong hands. Here's how it works. Buy a $1 million property with cash. It appreciates 10%. You made $100,000. Decent. Buy the same property with $200,000 down and an $800,000 loan. Same growth. You've turned $200,000 into $300,000, a 50% return. Same house, same market, completely different outcome. Elon Musk borrowed against his Tesla stock to buy Twitter. No sale, no taxable event. Leverage as a tax strategy. 4 rules before you use it. Know exactly what's on the line as collateral. Understand your downside before you calculate the upside. Never borrow to survive, only borrow to multiply. And remember, leverage doesn't create wealth. It multiplies what you already have. If what you have is weak, leverage makes it weaker, faster. Law number 4. Cash flow keeps you alive. Equity sets you free. For the first years of my career, I optimized entirely for cash flow. Good income, nice lifestyle, always busy. What I didn't realize was that I was building a job, not a business. The moment I stopped working, the money stopped too. I had cash flow. I had zero equity. And equity is the only thing that works while you sleep. Here's the difference. Cash flow is the salary. Equity is the ownership. One pays your bills today, the other funds your entire future. McDonald's sells burgers, cash flow, but their real wealth is $1.6 billion in royalties and $45 billion in real estate. The business everyone sees funds the empire nobody notices. Best vehicle for equity? Your own business. Second best, a piece of someone else's. Stocks like Amazon, Google, Tesla. Stop optimizing just for income. Start buying ownership. Cash flow is the vehicle. Equity is the destination. Law number 5. Risk and reward are not a straight line. A venture firm invests $100K each into 5 startups. Total at risk, $500K. 2 go to 0. Third breaks even. Fourth returns 10x. Fifth returns 100x. The last 2 alone erase every loss and generate life-changing returns. That's asymmetry. The ability to risk $1 and potentially make 100 while knowing exactly how much you stand to lose. This is not recklessness. Asymmetry is calculated. The goal isn't one big win. The goal is staying in the game long enough for the big wins to find you. Law number 6. Never bet your empire for a pot of gold. A friend and his wife spent 15 years building $700,000. Disciplined, consistent. They were proud of it. Then came the deal. Oil and gas. Great tax advantages. A trusted friend vouching for it. They went all in. 2 years later, zero. 15 years of work gone in one decision. The mistake wasn't the investment. It was the bet size. Ray Dalio's framework says it clearly. Every investment has a risk-return ratio. Your job isn't to chase the highest return. It's to get the same return with less risk. Most investors try to increase reward. The best ones quietly reduce risk. 2 rules. Protect the machine that generates your opportunities. Never burn it for one swing. And only go big when your downside is defined and capped. Law number 7. Diversification is protection for people who don't know what they own. Wall Street says spread everything. Wealthy people often do the opposite. Here's the real framework. 2 factors: how well you understand the risk and how much control you have. Understand the risk, plus have control. Concentrate. Go all in. This is your own business. Understand the risk, but no control. Invest selectively. Blue chip stocks are fine. Have control, but don't understand it. Find a key operator before you touch it. No understanding, no control. Diversify. Spread the bets. Musk keeps most of his wealth in Tesla, Bezos in Amazon, Zuckerberg in Meta. They're not reckless. They have conviction backed by deep knowledge. Remove their equity and they fall off the Forbes list overnight. That's the point. Before any investment, ask yourself these 5 questions and be brutally honest. Can this compound over time, or does it pay once and stop? Who actually controls this? You or someone you're trusting blindly? If it fails completely, what do you walk away with? Is the upside meaningfully larger than the downside? Not slightly, massively. And finally, can you clearly explain, out loud, exactly what could go wrong? That last question is the only filter you'll ever need. If you can't answer it, you don't have an investment. You have a hope Here's what I want you to understand. Most people will watch this, nod along, and do nothing. They'll keep chasing speed while time runs out. They'll keep collecting cash flow while someone else collects equity. They'll keep diversifying out of ignorance and calling it strategy. But a small number of you will take these laws seriously. You'll apply them to real decisions. And 5 years from now, the gap between those two groups will be staggering. The next step is the system, a step by step framework for applying every one of these laws to actual decisions, even when the answer isn't obvious. That's what we break down next. Don't miss it.